My first guest happens to be a market historian, among other things, and he agrees with this. He is still a bull on the market. Joining me now, Fisher Investments founder Ken Fisher. Ken, thank you so much for joining. I've got some observations for you. First and foremost, let's start with the notion that this is a bull market.
It is a bull market. The reality is that we've been, for the last 3 weeks, more or less straight off the top, and there's legendary saying that bull markets die with a whimper, not with a bang. Traditional bear markets that are then accompanied by recession have a slow, steady start at the beginning, not a steep plunge. This is a steep plunge off the top. This is an attempt at a correction, as you said earlier.
One note that you have here, that Americans are too fixated on America. What does that mean?
Well, when you look at the global world, you see several things. One, this concept that so many people have wrongly had, that the market was only about the Magnificent Seven or the Fab Four or whatever you want, is just wrong when you look at how many countries around the world that have nothing to do with tech have hit all-time global highs this year. But also, there's been this fixation on the Fed and inflation and interest rates. But the reality is, when you look overseas, Europe in particular, you see that their inflation, which went up higher faster as a rate, has actually fallen faster and is now lower than in America. If you think about inflation, it is always ends up getting averaged out around the world, and the pessimism in America about America is missing the optimism from overseas.
Right. Hey, also, market corrections are common in the second quarter of a presidential election year. I've shared that chart several times on this show with the audience. I want to go to what to expect in general, right? Because, I try to do this all the time, and just a reminder, these 5% moves are going to happen every 1.1 year. So what we've seen recently probably was overdue. But what do you make of where the money is going? All of this cash that, for instance, is poured into the bond market, do you think that's a smart move?
Well, first, are you trying to say that stocks can be volatile sometimes?
Occasionally they go down, Ken.
Gee, I wish somebody had told me that a long time ago. The other thing, however, I'm not going to argue against your bond point, but except you said all, and of course that's not true. If you think of it, doesn't all go into one place. And one of the things that happens when the market falls a lot in a hurry, as it did this time, is a lot of it just gets out and goes into bank deposits. And you can see that just simply in the last few weeks, Friday Fed data coming out of the St. Louis Fed, that bank deposits, which had been more or less steady before, have gone up sharply. Because fundamentally, if you sell in a hurry, you don't necessarily know where you want to go in a hurry. It takes a longer downturn to where you reallocate the money. That's
a great point, Ken. One of the reasons I like bringing you on is because, you've been there, you've seen this, and you've guided so many people to, economic prosperity. So just, again, a word, I've got 30 seconds, but just what you're telling folks who still grab you, they see you outside, they call you up, whatever. Hey, Ken, I'm still concerned. What exactly do you say to them, just point blank? Because I see these dips as opportunities, but so many people see them as a reason to get out.
Presidential election years are overwhelmingly bullish. Presidential election years that follow second years of a president's term that were down since the bottom of the Great Depression in 1932 have always been positive, up an average of 15.7%. This is a bull market. Just enjoy it, even though stocks are volatile time to time.
Hey, volatility is a price I'd be willing to pay to make a lot of money. Ken, thank you so much. I appreciate you.
Thank you always.
See you.